I wasted years believing that reading financial reports and listening to market experts was the key to making money in the stock market. And it cost me. With so many so called gurus pushing complicated strategies, it's no surprise that 90% of investors end up stuck in sideways stocks, waiting years for profits that may never come. But over the last decade, I've refined a simple, trend following system built around one rule. If a stock isn't obvious, it's not worth your money. So, in this video, I'll show you a clear, repeatable method that filters out weak stocks, removes emotions from your decisions, and helps you spot profitable stocks within seconds of looking at a chart. This is the exact system our members have used to double their account over the past 2 years. Okay, so the first step in this process brings total clarity to the stock selection process and makes spotting high probability opportunities simple and objective. Without it, you'll be second guessing decisions, overwhelmed by information, and slowly draining your account through avoidable mistakes. You've seen what most traders do. They set up multiple monitors, 3, 4, 6, even more monitors on their desk. That's breaking financial news playing in the background. Their charts are covered in indicators, RSI, MACD, Bollinger Bands, lines everywhere. The most important indicator, the price of the stock itself, is buried deep underneath all of that. Every time frame is open because they're afraid of missing something. They believe more information equals more control, but it doesn't. It creates hesitation, it creates emotional decisions, and it creates forced trades and investments. And confusion always shows up in the performance of your portfolio. There's just no hiding from it. The truth is, if you need 10 different tools to decide whether a stock is worth buying, you don't have a system. You have noise and you have chaos. What you need is a clear starting point. One view of the market that instantly tells you whether a stock deserves your attention or whether you should move on without a second thought. Because if the first step isn't clear, everything that follows becomes guesswork. And guesswork, well, it's expensive. I'm not using 5 monitors, I'm not pulling up news, and I'm not trying to process 10 different things at once. It's just one screen and a simple 3-chart layout. Let me show you how that looks on the charts. Okay, so what you have here is the monthly time frame in the top left. You've got the weekly time frame in the top right, and you've got the daily time frame along the bottom. Now, these 3 time frames give you a complete picture, not a confusing one. You can instantly see whether there's a real opportunity here or whether it's a stock you should ignore. And this is exactly why we created the stock market blueprint. It gives you the process our community and I use every week to cut through the noise and find stocks with the potential to rise 80% even more. I've put the link below so you can download it. Now, the first step is the monthly chart. So let me enlarge that. Now, the monthly time frame is where we zoom out and look at the bigger picture, the stock's historic price action. This is the view that tells you what's actually happening overall. Because if you can't answer this one question first, everything else you do after that becomes total guesswork. Is this stock moving up? Is it moving down? Is it moving sideways? And think of it like this. The monthly chart is like being in a plane looking down. You're not staring at just one street. You can see the wider view of the whole city. Now, what we're looking at is the monthly time frame of CBOE global markets. You can see where the price started to trend down here, and it has moved up consistently over time, creating higher highs and higher lows. This tells us straight away that it's in an uptrend. There's no arguments here. It's very, very clear. And that's what I like about the monthly time frame. Now that we've established the trend, there's one thing I need to add to the chart that makes the monthly time frame even more useful. And that is the high and the low of the previous calendar year. This green marker is the high of the previous calendar year, and this red marker is the low of the previous calendar year. Now, these levels matter because they often act as major support and resistance levels, areas where price tends to react. And now that we can see them on the charts, here's what I'm actually looking for. Is price comfortably above the previous calendar's high? And we can see right here that CBOE is currently trading above the high of the previous year. Because if it is, ultimately it means price has already pushed through a major barrier. And in this case, not only is it above last year's high, it's also pushing onto new all-time highs. And that's what I call clear skies. And clear skies matter because they give us a strong indication that the stock can keep moving higher, as there's no resistance levels in the way that could potentially push price back down. Okay, so now I've switched over to Berkshire Hathaway, and we can see that it's the complete opposite situation. Berkshire Hathaway is actually trading inside these annual levels, and the high of last year acted as resistance and forced the price of Berkshire Hathaway down, and it's now remained inside this area of consolidation. So even though overall the stock is moving up, we can see how this level has forced the price down currently and is moved into sideways market now for a number of months. So clearly the price has stalled and it's struggling, and it has the very real potential to completely reverse back to the downside. And this is where a lot of people get caught. They jump in early because they think, hey, it's moving up, I don't want to miss it. But if you enter before price breaks above that previous high, you're buying a stock where the odds aren't in your favor. As long as it remains in this consolidation, this sideways period, this is a low probability stock. So the question is, what do you do instead? As investors, we've applied that all important investor skill, which is patience. We wait. We let price prove that it can break above the high of last year and break through that barrier first. And then we can start considering it as a potential opportunity, because the entire point of this system is not to be first. What we want is the odds stacked in our favor. And the way we do that is by making sure price has moved past the obvious roadblocks, in this case, the high of last year, and has space to run, which is why we also want to see it setting record highs. Once it proves itself by breaking through the high of last year, only then are we ready for the next part of the process. Okay, so step 2 only matters once a stock has already proven itself in step 1 by moving through the high of last year, because this is where we take a closer look and confirm whether it actually deserves a place on our list. A stock can look strong from a distance, but still have problems hiding underneath the surface. And this is where a lot of investors get caught. They see a stock moving higher, assume that means it's a good opportunity, and stop their analysis there. It's actually quite flimsy. But just because a stock is going up doesn't automatically mean it's moving well. Some stocks climb in a clean, controlled way. Others are erratic. They surge higher, drop sharply, bounce back again, and whipsaw investors in and out of their positions along the way. On the surface, both might look like they're moving up, but once you inspect them more closely, the difference becomes actually quite obvious. And that difference absolutely matters, because if you're putting your money into a stock that has a history of violent, unstable price movements, ones that are extremely volatile, ultimately you're increasing the chances of being shaken out of your positions, entering at the wrong time, or sitting through unnecessary risk. This step helps us read the stock's behavior properly. It lets us look at the past trend and inspect the quality of the move itself. Has the stock been making steady progress, or has it been unpredictable and difficult to hold? Because we're not just looking for stocks that move, we're looking for stocks that move well. And that's a really important distinction. And once you know how to spot that difference, it becomes much easier to filter out the weaker opportunities before they ever make it onto your shortlist. Okay, so let's move back to the charts. Now we're looking at the weekly time frame for CBOE, and looking at this chart, you can already see that it is clearly trending up. A very nice, clean, linear move to the upside. But at this stage, we're not just asking, is it going up? What we want to know is, how strong is this move really? Because a stock can be trending higher and still not be the kind of stock we want to put on our shortlist. So the first thing I'm going to add here is the 200 simple moving average. And this is this black line along the chart here at the bottom. And this gives us a very quick read on the bigger trend. As long as price is above the 200 simple moving average, that immediately tells us that this stock is in an uptrend. If price is below the 200 simple moving average, then in most cases, we're dealing with a downtrend. And that's not what we're looking for. So right away, that helps us stay extremely objective. We're not guessing. We're not trying to force an opinion onto the chart. We're just asking a very simple question. Is price above or below the 200 simple moving average, which CBOE Global Markets is clearly trading above the 200 simple moving average? If it is, good, we keep going. Now, the next thing I'm going to add is the 50 simple moving average. And that is this orange line that had just appeared on the chart. And this is where we start to get a better feel for the structure of the move, because in a healthy uptrend, price should be above both the 200 and the 50 simple moving averages. But more importantly, we want to pay attention to how price behaves around the 50 simple moving average. If a stock keeps pulling back to the 50 simple moving average, touching it, or regularly dropping deeper, potentially even to the 200 simple moving average before it then moves higher, what that's usually telling us is that this isn't a very clean linear stock, and in fact, it's actually quite volatile. And that absolutely matters, because a stock can still be moving up overall, but if it keeps making deep pullbacks, then it often means deep corrections or long periods of consolidation before it potentially starts moving back up again. And those are usually not the kind of stocks we want to focus on. Those stocks that move regularly to the 50 simple moving average and below it to the 200, we kind of want to dismiss them. Because if a stock runs up, then pulls back hard, then goes sideways for weeks or even months, it can take a long time before you're finally sitting on a meaningful amount of profit. And even when it does start moving again, the same patterns often repeat. It pushes up, it pulls back, it stalls, then eventually it moves higher again. So yes, technically it may still be trending up, but it's not doing it in a way that makes the opportunity attractive. Okay, now compare that to Amphenol on the weekly time frame. If we compare it to CBOE, you can actually see that this is a much cleaner looking trend. When it moves away from the 50 simple moving average, there's quite a lot of white space between price and the orange line, which is exactly what we want. It then came back, bounced around it, created a base, and then it moved again. And if you look at it again, you can see how far it's moved away from the 50 simple moving average, a very clean linear trend. This is the kind of move we want to really pay attention to. It's still rising, but the pullbacks aren't as deep. It's not dropping all the way back into the 50 simple moving average when it starts trending. This tells us that the trend is behaving much better. It's cleaner, it's more controlled, and it suggests that the buyers are staying in control without giving back too much ground. So at this stage, that's what we're doing. We're not just confirming that the stock is in an uptrend, we're also judging the quality of that uptrend. And in the next step, I'm going to show you how to take this one step further so you can identify and confirm the strongest, most linear moves in the market. Now we move to the daily time frame. And this is where we start filtering properly, because not every stock that passes the monthly and weekly stages will be ready to invest in immediately. Some will be correcting, some will be moving sideways, and some will be losing momentum. So the daily time frame helps us narrow everything down even further. This is where we confirm whether the stock we're looking at is actually behaving like a strong trending stock right now. When you combine all three time frames, monthly, weekly, and daily, something very important happens. You stop guessing. You stop relying on opinions, news, or whatever you think a stock might do. Instead, you're letting the chart tell you the story across the big picture, the medium long-term trend and the short-term behavior, all at the same time. And when all three of those are aligned, that's when a stock becomes a high probability opportunity. This step is what filters the good stocks from the great ones. It's what stops you from buying stocks that look good, but ultimately go nowhere. And it's what helps you focus only on the stocks that are actually moving and have the potential to keep moving up. Okay, so here is the daily time frame for Amphenol. We know that the weekly time frame is bullish because price is above the 50 and the 200 simple moving averages. Now we want the daily chart to confirm the same thing. So the first thing I'm going to add here is the 200 simple moving average. And just like on the weekly, we want price to be trading above the 200 simple moving average, which it absolutely is doing. This tells us that the shorter term trend is still aligned with the bigger picture. So now, instead of having one time frame pointing up or two time frames pointing up, we've got all three starting to line up together. And that's where this process becomes powerful. But this is the key part. To really judge the strength and structure of the trend, I'm going to add two more indicators. The first, as you probably guessed, is the 50 simple moving average, which is the orange line that's just appeared on the chart. And the second is the 20 simple moving average, which is this blue line that's appeared on the chart. So now we've got the 20, the 50, and the 200 simple moving averages all on the daily time frame for Amphenol. Now, these two indicators that I've just added on help us separate an average trend from a strong one. That's the 20 and the 50 simple moving averages. What we really want to see is a stock trending above the 20 simple moving average. That's the ideal scenario. If price pulls back, touches the 20 simple moving average, and then bounces higher, again, that's completely fine. In fact, that's exactly the kind of behavior we like to see. That is what we call a linear stock, because most of the time that tells us a strong linear trend is in play. And those are the types of stocks we absolutely want to focus on. Why is that? Because when a stock keeps respecting the 20 simple moving average, as Amphenol has been doing, and pushing higher, well, that usually tells us that the trend is strong, controlled, and advancing without giving up too much ground. That's what leads to faster, cleaner profits. The stock isn't spending weeks drifting sideways or making deep pullbacks. It's moving at a fast pace. Now, if a stock pulls back deeper and hits the 50 simple moving average, well, that's still fine. That doesn't automatically make it a bad stock. It just tells us that the corrections are deeper and the move is a little slower. So if price comes back to the 50 simple moving average, finds support there, and then continues higher, the overall trend can still remain intact for a long time. It just means we're probably looking at a stock that won't move as quickly or as cleanly as one that's riding the 20 simple moving average. So ideally, we want to see price bouncing along the 20 simple moving average. That's the strongest behavior. The 50 simple moving average is still absolutely acceptable. But once price starts moving lower than the 50 on a regular basis, that's where the quality starts to drop. Because if a stock has a history of falling below both the 20 and the 50 simple moving averages, then what we're really looking at is a more volatile stock. And those are not the kind of stocks we want near the top of our watch list. So in practice, this is how I'd separate them. The best stocks, the ones at the top of the watch list, are the ones bouncing and holding above the 20 simple moving average. Then the second group would be the stocks that are still behaving reasonably well, but are using the 50 simple moving average instead. Anything weaker than that, anything dropping too deeply or too often, we push to the side. Because the goal here isn't just to find stocks that are going up. It's to find stocks that are going up in the cleanest, strongest, most consistent way possible. And once we've confirmed that across all three timeframes using this method, then the job of filtering is done. Now, at that point, it's time to move from analysis to execution and start adding the best stocks into the portfolio using our entry system. And this is exactly why having the process mapped out matters. The same steps I've just shown you are outlined inside our stock market blueprint, which is the tool our community and I use every week to filter the market and find the strongest stocks before they become obvious, including stocks that go on to rise 80% and more. I put the link below so you can download it. Okay, so knowing a stock is ready to be added to the portfolio is one thing. Knowing exactly where to enter, where to protect yourself, and how to avoid ruining a good setup with bad timing is what really matters, because even the strongest stocks can turn into a losing investment if the execution is poor. You don't want to get in too early and watch a promising setup roll over before it ever confirms itself. And you don't want to get in too late either, because by that point, a good portion of the move has already happened and you're giving away profit that should have been yours. So this step is about precision. It's about waiting for the market to show its hand before you commit capital. Because the goal is not to predict what a stock might do next. The goal is to wait for price action to confirm that it is already moving in your direction. That one shift changes everything. It helps you avoid premature entries, it helps you reduce unnecessary losses, and over time, it puts you in far better positions to let winning investments do the heavy lifting. This is one of the biggest differences between randomly buying good-looking stocks and building a repeatable process that can steadily grow your account over the long term. Because if you get this part right, your win rate improves, your risk becomes more controlled, and your capital has a much better chance of compounding the way it should. Okay, so let's walk through exactly how this looks on the charts. What we're looking at again is the daily time frame for Amphenol. Now, the first thing I'm looking for is a breakout above a previous high. So if I just mark this level here, you can see that Amphenol went through this period of consolidation and then it broke above this previous high. Now, I've also added our tool that adds breakout signals or highlights breakout signals on the chart. So these little green markers are breakout signals. Price pushes up, breaks above that previous high, and that breakout is what gives us confirmation that the stock is ready to move up into the next stage, start trending, potentially hand out profit. Now, this is important. We do not enter on the first breakout signal because the first breakout signal can often be a fake breakout where it reverses back into consolidation. We actually wait until after the breakout. We wait for potentially the second, third, even the fourth breakout signal to say that the stock actually wants to trend and wants to continue moving further up. And the reason for that is straightforward. We want confirmation. We certainly do not want anticipation. A lot of people jump in too early because they think the stock is about to move. But that approach increases the chances of getting caught in a false move. What we want is proof that the price is continuing higher, which is why we prefer to wait for the third or potentially even the fourth signal. So once we get this breakout candle right here, the next step is to go into the broker account and place an entry order slightly above the high of that breakout bar. We don't go in at market prices. We want to put our entry slightly above the high of that breakout candle. In this case, we're placing it at least 20 points above that high. That becomes our trigger level. And the reason for that is we're not manually chasing price. We're setting the order in advance, and if price continues through that level, the order is triggered automatically. It removes all the emotions and guesswork and brings a very objective approach to entering into a stock. That way, the market has to prove it wants to keep moving higher before we get involved. Now, while we're placing that entry order, we also need to define the risk. And this is where the stop loss goes in. So to do that, I use the Donchian 20. So let me just load that up onto the charts. Now you can see that this red line here across the bottom, this is the Donchian 20 low, and that becomes my stop loss and my trailing stop loss. That's where the stop is going to be placed in the broker account. And the reason I use the Donchian 20 is because it tracks price very well while still giving the position enough room to move. Donchian 20 is the last 20 trading days. So you're looking at about a month of data. If the stock starts declining and falls through that Donchian 20 low, that's a strong sign that the trend may be over, the trend has failed, and that at that point, we want to be out. So it gives us a very simple and objective exit. Now, once the investment is live, the job becomes managing it properly. As the stock continues to move higher, the Donchian 20 will also start rising with price. And as that line moves up, we update the stop in the broker to match the new level. So the stop isn't fixed in one place forever. It trails the trend. That's what allows us to do the two very important things at the same time. Cut the position quickly if it fails, and stay in the investment if it keeps working. Now, in a strong trend, what should happen eventually is the Donchian 20 rises above our entry level. And once that happens, the position becomes risk-free, because even if the stock reverses and stops us out, we're no longer taking a loss. At worst, we come out flat. And if the trend continues higher from there, then the stop keeps rising, the locked-in profit keeps increasing, and eventually, if we do get stopped out, we exit with a gain. So this is the whole process. We wait for the breakout, we place the entry above the breakout candle, we set the stop at the Donchian 20 low, and then we trail the stop higher as the trend develops. It's simple, it's objective, and it removes a huge amount of emotion from position management. Okay, so this is what it looks like on the charts. This was the initial breakout where we entered our position. We got triggered above the high of this breakout bar right here. The trend then moved in our favor, walked along the upper Donchian, and you can see that the lower Donchian follows as our trailing stop loss. When that Donchian channel moves above the entry, which is around here, the position becomes risk-free. And from then on, it's all profit that we are locking in. And it's at this point here where Amphenol reverses and hits the Donchian channel, walks along it, and triggers us out of our position. Now, me personally, I like to look for at least 2 closes along the lower Donchian. You can see that there was 1 close here and then reversed. So it gives the stock just that one more chance to potentially reverse back in our favor. When I get the second close, as we do here, this is when I look to exit our position. And so that's the whole process on the chart. And so when you apply this consistently over the long term, this is what allows small risks to turn into very large gains when you catch a strong uptrend. Now you know how to spot profitable stocks in seconds. You need to know when to enter a position at the most opportune time for higher returns. So watch this video next, where I show you how to do this using our 4-phase system.